Hello, rooted ones. Welcome back to another session of breaking down the big business topics. Today, we're talking about corporate financial management, how companies raise money, distribute profits, and balance their finances. These concepts might sound tricky, but I promise to make them easy to understand. Let's get started. Corporate financing, debt versus equity. When a company needs money to grow, it has two main options: borrow it, debt, or sell part of the company, equity. Let's explore the difference. Debt, like loans or bonds. The company borrows money and promises to pay it back with interest. Think of it like a personal loan, except instead of going to the bank, businesses often issue bonds for investors to buy. Pros: the company doesn't give up ownership. Cons: it must pay back the money, even if the business doesn't do well. Equity, like stocks. The company raises money by selling shares, which means giving up part ownership to investors. Pros: there's no obligation to pay the money back. Cons: the more shares sold, the less control the original owners keep. Think of it like choosing between borrowing money from a friend, debt, or letting them co-own your lemonade stand, equity. Both options have pros and cons depending on your goals. Understanding stock dividends and their impact: companies don't just sell shares, they can also reward shareholders with dividends, a portion of the company's profits. Dividends come in two main forms: cash dividends. Shareholders receive a payout in cash. It's like getting a bonus for investing in the company. Stock dividends: instead of cash, shareholders receive additional shares. This doesn't reduce the company's cash, but increases the number of shares owned. Here's the important part: stock dividends don't reduce the company's overall value, but they do spread ownership across more shares. It's like cutting a pizza into more slices. Everyone gets a smaller slice, but the pizza is still the same size. Rights and obligations of bondholders and shareholders. Now let's talk about the people who invest in a company. There are two main groups: bondholders and shareholders. They both play important roles but have different rights and responsibilities. Bondholders: they're like lenders. They loan money to the company in exchange for regular interest payments and repayment of the loan later. Rights: bondholders don't get a say in how the company is run. They're only concerned with getting their money back. Risk: if the company struggles, bondholders are paid before shareholders. Shareholders: they own part of the company by purchasing shares. Their success depends on the company's performance. Rights: shareholders can vote on major decisions like electing directors or approving mergers. Risk: if the company does poorly, shareholders might lose their investment, but if the company does well, they share in the profits. Think of bondholders as people who rent out money to the company and shareholders as part owners. Both are crucial, but their rewards and risks are very different. Wrapping it up, and there you have it, Rooted Ones, a guide to how companies manage their finances, reward investors, and balance debt and equity. Whether you're thinking of starting a business or investing in one, understanding these basics will help you make informed decisions. If you found this helpful, don't forget to like, share, and subscribe for more insights. Stay rooted, stay informed, and keep growing.